Over a single week, India's foreign exchange reserves plummeted by $11.6 billion. It is the single largest weekly drop the central bank has recorded in over a year. For the Indian public, the phrase falling Forex reserves hits a very specific, deeply ingrained nerve. It triggers immediate economic anxiety. That anxiety leads straight back to the balance of payments crisis of 1991. The nation was pushed to the absolute brink of default, watching its foreign reserves evaporate until barely $1 to $2 billion remained in the bank. The desperation reached a point where India had only enough dollars to cover 2 weeks of essential imports. To survive, the government had to physically load its national gold reserves onto secure transport planes and pledge them to the International Monetary Fund. Fast forward to today. Global geopolitical conflicts are escalating. Oil supply chains in the Middle East are under severe stress, and India's reserve numbers are once again dropping rapidly. This raises an immediate question. Is the domestic currency actually in danger of collapsing, or is there a specific mechanical reason why $11 billion vanished in 7 days? The headlines paint a picture of an economy bleeding cash, but if you look under the hood, the entire architecture of India's wealth has mutated since that crisis 3 decades ago. To understand the drop, we have to look at the starting line. Today, the Reserve Bank of India manages a financial war chest sitting at a staggering $716 billion. This chart ranks the top global Forex reserves. India sits firmly in the number 5 spot, behind China, Japan, Switzerland, and Russia. As the data transforms, you see this $716 billion comprises $563 billion in foreign currencies and $130 billion in gold. This U.S. Treasury bond represents the mechanism the RBI uses to manage its wealth, investing foreign currencies into secure international assets that provide a steady yield. The central bank also holds special drawing rights at the IMF. An SDR is an international reserve asset based on a basket of 5 major currencies, including the dollar, euro, and yen, which acts as an emergency liquidity buffer that countries can tap into during a crisis. This vast reserve functions as an actively deployed financial shock absorber, engineered to take the impact of global macroeconomic hits so the domestic economy stays protected. That brings us to where the missing $11.6 billion went. The Indian economy is currently fighting off 4 specific, simultaneous external pressures. The first strain is active defense. As global tensions rise, the rupee faces massive pressure to depreciate. To keep the currency from crashing past 92 to the dollar, the RBI releases millions of its stored US dollars into the open market, artificially increasing supply and stabilizing the exchange rate. The second pressure point is the currency valuation effect. This happens when the US dollar flexes and gets stronger. Because the RBI holds a basket of different currencies, assets like the euro and the yen mathematically shrink in value compared to the dollar, pulling the total reserve number down with them. The third drain is the flight of foreign portfolio investments, or FPI. FPI is simply the money international investors pour into local stocks and bonds. When war fears spook the global market, investors pull their money out of the Bombay Stock Exchange, convert their rupees back into dollars, and take it home. Finally, the rising cost of imports. India buys massive amounts of crude oil and fertilizer from overseas. When geopolitical conflicts cause global commodity prices to spike, India has to spend more of its dollar reserves to settle those exact same import bills. The $11.6 billion drop reflects the calculated cost of defending the domestic market from a highly volatile world, rather than incompetence or mismanagement. But defending the rupee is only half the strategy. Over the last few years, the RBI has been executing a quiet, aggressive tactical maneuver, stockpiling physical gold. Look at this area chart tracking asset distribution. Historically, gold made up roughly 6 to 8% of India's total reserves. Today, that yellow section has surged, eating up a massive 17 to 18% of the entire portfolio. This is a direct response to modern financial warfare. Watching the severe sanctions placed on Russia proved that holding massive amounts of US dollars leaves a country vulnerable to having its assets frozen. Gold, on the other hand, is universally accepted and entirely politically neutral. To diversify the physical risk, the RBI doesn't keep all those newly acquired bars within India's borders. Portions of it are strategically stored overseas in highly secure, trusted vaults, like the Bank of England. By aggressively expanding its gold reserves, India is buying a massive insurance policy, heavily insulating its national wealth from the political influence of the United States. So, when you see a headline about an $11 billion drop, you are watching a functional financial shock absorber doing exactly what it was designed to do. In 1991, India had enough money to cover a few weeks of imports. Today, even after this massive drop, the RBI retains enough capital to cover a comfortable 10 to 12 solid months of global bills without blinking. That level of security doesn't mean the economy is completely invincible. Prolonged conflicts, particularly in the Middle East, remain a severe and active threat to India's financial borders. This map visualizes a critical vulnerability: remittances. Over $100 billion flows into India annually from citizens working abroad. As the animated streams show, a massive portion of that capital originates directly from workers stationed across the Middle East. If a widened regional war forces those workers to evacuate, those data streams dry up. Without that steady influx of cash, the central bank would be forced to burn through its defensive reserves at a much faster, more dangerous pace. The trauma of 1991 forced India to build a $716 billion financial fortress. Today, a falling number in the headlines is simply the sound of that fortress successfully repelling an attack.